Disclaimer: global debt hit $323 trillion in the third quarter of 2024, an increase of $12 trillion in just 9 months. That's 326% of world GDP, higher than pre-pandemic levels and 3 times what it was 2 decades ago. But here's what the headlines miss. While everyone focuses on U.S. and European debt, the real crisis is brewing in emerging markets. Emerging market debt reached $105 trillion in 2024, representing 245% of their GDP. And unlike wealthy nations that can print money or refinance easily, emerging economies are trapped. They're paying interest rates 2 to 4 times higher than the United States, while their revenues are collapsing. This isn't just their problem. When emerging markets collapse, the entire global debt system goes with them. Let me show you why this matters more than most people realize. Developing countries will pay a record $400 billion in external debt service in 2024, money that would otherwise go to healthcare, education, and infrastructure. Between 2022 and 2024, emerging markets paid out $741 billion more in debt payments than they received in new financing. That's the largest outflow gap in at least 50 years. Capital is flowing backwards from the poorest countries to the richest creditors, and it's accelerating. From 2020 to 2023, there were 15 sovereign defaults driven by pandemic fallout, commodity shocks, and surging inflation. Ghana, Zambia, and Ethiopia have already defaulted or entered restructuring. 13 sub-Saharan African countries are at significant risk of financial crisis, according to the IMF and World Bank. Argentina's debt exceeds 100% of GDP, while inflation hit 143% in 2023. Kenya recently issued bonds at 9.75% interest, a rate experts consider unsustainable. Ecuador and Suriname defaulted since 2020. Latin American debt jumped from 58% of GDP in 2019 to over 70% in 2020 and hasn't recovered. Thailand raised its debt ceiling to 70% of GDP and will spend 13% of revenues just on interest by 2026. Laos has debt exceeding 108% of GDP, with inflation over 30%, forcing asset for debt swaps to avoid default. This is the pattern. Emerging markets borrowed heavily when interest rates were near zero from 2009 to 2021. Global quantitative easing pushed investors toward higher yields in developing countries. Emerging market bond issuance tripled from $1 trillion in 2007 to over $3 trillion in 2024. They borrowed dollars at 2 to 3% rates. Then everything changed. The Federal Reserve raised rates from 0% to 5.5% in just 18 months. The European Central Bank went from negative rates to 4%. Suddenly, the cost of dollar-denominated debt exploded. For emerging markets, real yields at bond issuance rose from negative levels in 2020 to nearly 4% in 2024. For low-income countries, yields climbed from 4% to over 7%. And here's the critical problem. Over $4.5 trillion of emerging market bond debt, about 40% of their total outstanding, matures by 2027. More than 20% of that debt matures in 2025 alone. All of it must be refinanced at 3 to 4 times higher than the original borrowing cost. If this analysis is making the global crisis clearer, subscribe for breakdowns of finance and economics that affect the real world. Understanding why emerging markets matter isn't academic. When they collapse, the contagion spreads globally. Subscribe because what happens next will reshape the world economy, and most people have no idea it's coming. The mathematics of emerging market debt are unsustainable. When you borrow at 2% and your economy grows at 5%, you can manage the debt. Your growth exceeds your borrowing cost. But when borrowing costs jump to 8% and growth slows to 2%, the debt becomes impossible to service. You're paying 8% interest while only growing at 2%. Every year, the debt burden gets heavier relative to your economy. This is the trap facing most emerging markets right now. They borrowed when money was cheap. Now, money is expensive, and their economies are stagnating. The World Bank warned that global economic growth from 2020 to 2024 would be the weakest half-decade performance in 30 years. Emerging market growth is projected at just 1.9% in 2024, the lowest among all global regions. They're growing slower than their debt costs. That's the definition of a debt spiral. More borrowing to pay interest on old debt. The debt grows faster than the economy. Eventually, they can't pay. Default becomes inevitable. When emerging markets default, the damage doesn't stay contained. The global financial system is interconnected through debt holdings, trade relationships, and investor portfolios. Let me show you how the contagion spreads. First, who holds emerging markets debt? International banks, pension funds, insurance companies, sovereign wealth funds, and wealthy investors across developed nations own trillions in emerging market bonds. When developing countries default, these creditors lose money. A bank holding $50 billion in emerging market bonds that default loses that capital. If losses are large enough, the bank becomes insolvent. We saw this pattern in 1982 when Latin American defaults nearly collapsed major U.S. banks. We saw it again in 1997 during the Asian financial crisis when defaults spread from Thailand to Indonesia to South Korea and almost triggered a global banking collapse. We saw it in 1998 when Russia's default caused long-term capital management, a major hedge fund, to implode, requiring a Federal Reserve bailout to prevent systemic collapse. Second, emerging markets are critical to global supply chains. China holds $34 trillion in debt domestically and is the world's manufacturing hub. India holds massive debt and is a key technology and pharmaceutical producer. Mexico is integrated into North American supply chains. Brazil is a major agricultural exporter. When these countries face debt crises, they cut imports, devalue currencies, and implement austerity that crashes their economies. Global trade contracts, supply chains break. Companies in developed nations lose customers and suppliers simultaneously. The 2008 financial crisis started in U.S. housing but spread globally because the financial system is interconnected. An emerging market debt crisis would follow the same pattern, but potentially larger in scale because emerging market debt has tripled since 2008. Third, the hidden liabilities make the crisis worse than official numbers suggest. State-owned enterprises in emerging markets have massive debts that aren't counted in official government statistics. The IMF's new Debt at Risk framework warns that if things deteriorate with slower growth, fiscal failures, and rising uncertainty, global public debt could hit 115% of GDP within 3 years, 20 percentage points higher than current projections. These unidentified liabilities sit like landmines in the financial system. When a state-owned enterprise defaults, the government often must bail it out, instantly adding debt to the national balance sheet that wasn't previously visible. Fourth, there's no effective rescue mechanism. The G20's common framework was designed to streamline debt restructuring for poor countries, but implementation has been painfully slow. Zambia's restructuring took 3 years. Chad's restructuring provided minimal actual relief. Meanwhile, Chinese lending to emerging markets has slowed dramatically, removing a major source of financing. Aid flows from developed nations are declining. The IMF and World Bank don't have enough resources to bail out multiple large emerging markets simultaneously. If Argentina, Turkey, Pakistan, and several African nations default at the same time, there's no rescue package large enough to contain the damage. The timeline is compressing. With over 20% of emerging market debt maturing in 2025 alone, and interest rates still elevated, defaults will accelerate this year and next. The system is approaching the breaking point where too many countries owe too much at rates they can't afford while their economies stagnate. History shows that when enough dominoes fall, the entire structure collapses. The 1930s Great Depression started with debt defaults that cascaded globally. The 2008 crisis started small and became systemic. The emerging market debt crisis that's building now has the potential to be larger than both because the debt levels are unprecedented. If this breakdown revealed how interconnected the global system really is, subscribe for more analysis of what's coming. Drop a comment and tell me which emerging market you think will default first and whether you think the crisis will spread to developed nations. Understanding the debt bomb isn't about predicting doom. It's about seeing reality clearly so you're not blindsided when the system that seemed stable suddenly isn't.